With the Fed cutting rates twice in 2025 and another move possible in December, what could the policy path look like as we head into 2026? And how might these shifts affect the yield curve, credit markets, and of course the outlook for mortgage-backed securities? And finally, what are the key drivers for investors navigating a changing landscape in rates, spreads, and fixed income opportunities in the year ahead? We're going to get to all of that and more right now with Leslie Falconio on UBS Trending. Hi, everyone, and thank you for joining us. My name is Anthony Pastori, and this is UBS Trending. Back in the studio with me is the head of taxable fixed income strategy for the CIO Americas, Leslie Falconio. Leslie, thank you for coming by. We have a lot to get to today, as we always do.
Absolutely.
I want to start with the Fed because just before we came into the studio today, there was some news about what the Bureau of Labor Statistics is going to do with the October jobs data that we did not receive because of the government shutdown. So it looks like they're potentially going to release it a little bit later in the year. But the question then comes up, how might that impact how the Fed is going to make a decision on whether or not they cut in December?
Yeah, I mean, that's, it's interesting, and you're absolutely right. They decided to, again, this is backward-looking data to begin with, right?
Always,
so
anyway.
The data is going to be a bit cloudy anyway, but they did push it out a little bit to mid-December, which would be probably after the Fed. So what the market did at that point was lower the probability of a December rate cut to about 30% right now. And remember, this went from, 100% probability of a cut in December before the last month's FOMC, then down to 60%. So now we're down to 30% of our probability of a cut. And as you know, Anthony, we're still staying with they cut in December, just simply because this data is clouded. We are expecting a little bit of slowing growth, go heading into the end of the year in the beginning of the first quarter of 26. So we're still staying with the cut in December, but the market is definitely, continuously pricing that cut out.
When you say the market's pricing it out, what is that doing to interest rates today as you looked at, say, the benchmark 10-year Treasury?
Yeah, well, what it has tended to do, it has tended to push interest rates up a little bit, but to tell you the truth, the probability of, going from 60% to a coin flip, 50-50, now to 30, it's not having as much of a magnitude as you originally did after the last FOMC meeting when, Powell came out a little bit hawkish in his statement. That's when you saw the big adjustment. And really what you've been doing is staying very range-bound in rates since that meeting.
Right, which actually takes us into what the yield curve looks like these days, which it's still normal, but what impact could that have on the overall curve when you go from the most short term to further out on the curve?
That's the great question, and it's sort of an unknown. And I'll tell you what I mean by that is that, look at the market. What the market's doing is that when we look at what we call the terminal rate, right, that rate where you're not restrictive or accommodative, right? So we look at this terminal rate at the end of 2026 in December. The projection is the Fed funds rate is like a 3.05%. That really hasn't moved very much, right? So, but the timing of the Fed cut has moved. So meaning that they've taken out the probability of a December to a low level of 30% and just pushed it into 2026. So now 2026 is anticipating 3 cuts, right? So the destination's the same, the journey's a little bit different, but in our view, they do go in December, but we don't think that they're going to go 3 times in 2026 from the information that we have right now. We think they go once in the first quarter, right? Or in the first half of the year, they cut one more time. Now, when it comes to the shape of the yield curve, as you mentioned, it's an upward sloping yield curve. We've normalized from the 2 years of inversion that we had, back, 10 months ago. But what we're thinking about in the yield curve is that short end, given that it's pricing in this terminal rate, in our opinion, is a bit anchored. And really, the shape of the curve is going to be dependent on that back end of the curve. So meaning that if growth is slower, 10-year yields come down, the curve flattens. As growth reaccelerates, it goes up, and you steepen out again. So our view is that the curve actually steepens, in 2026 because we have a reacceleration of growth outlook in the second half of the year. Doesn't mean you're not going to have pockets of this flattening, but overall we think a steeper yield curve.
Okay, interesting. I like that. And I like the fact that you talked about the journey might change a little bit. It's like when I was a kid, my father decided to take the scenic route home from Florida instead of taking I-95. Right. Everybody was car sick. It took a lot longer, but eventually we got home.
You're still going home.
That's right. But it was a topsy-turvy way to get there. So here we go with the markets trying to figure out and digest what the Fed may or may not do. Right. Credit spreads, we talk about this almost every single time you've been in the studio with me this year. They still remain historically tight tight. So I guess the question is, with yields still on the attractive side, though, what are your expectations when we look at credit, especially as we're looking into 2026? Do you expect those spreads to remain as tight as they've been in most of this year?
Well, listen, we've got IG corporate spreads now, say at 84 basis points. It really isn't very much different than where we started the year.
That's right.
Maybe 3 basis points difference. Now, going forward, things with investment-grade corporates, we could see some widening, right? But again, nothing material. And the widening is going to be more from a technical nature, not a fundamental nature. And what I mean by that is that with all, like we've talked about, the hyperscale and all this debt issuance that we're seeing, is that supply in IG corporates in 2026 could be up by, say, 20%, right? High yield on a gross basis. High yield could be up by 15%, right? The market's pricing this in. The market's expecting this. So we've had a little bit of underperformance in, investment-grade corporates, but by very little. And to your point, and what this chart shows, which is looking at a 25-year history of where these spreads and yields have been, they're still on that left-hand side, which makes them historically tight, if you will. So we are expecting some widening, but we're going to look at that as more opportunistic than a point of concern. Because again, it's not a fundamental concern, it's just a technical concern in terms of increased supply coming out because of, again, increased issuance hyperscalers, increased M&A, so that'll put some pressure on a little bit on IG corporates.
Normally with a tight credits, when you're in the markets are showing the spreads are really tight, that does reduce loan availability a little bit when you're looking at, getting access to certain products, right? I mean, when you think about what tight credit spreads mean, how does that impact the average investor?
Well, I think it depends on what, it's interesting because the senior loan officer survey is still, it's on the right path.
Yeah.
The credit markets remain open. We have loosening financial conditions still, so the capital markets are open, which are great. So in terms of the aspect of getting a loan, unfortunately, as we know, this is a K-shaped economy, and that's
right.
really what it's based on.
Yeah, and the K-shape means the top earners are going this way,
Doing well,
and
and
middle
the
and lower are going down.
So are struggling.
Right, and that's been the case for quite a while.
Quite some time.
Right. Okay, private credit. Obviously, we talk about alternative investments quite a lot, but private credit specifically, there's a lot of dry powder out there when it comes to these private credit issuers. With credit conditions potentially continuing to loosen here, what's your outlook for private credits as we go into the year ahead? Because it's a huge topic right now.
Oh, it absolutely has. And listen, let's be honest. I mean, the sentiment around private credit right now is not great, right? And, at the end of the day, poor sentiment could last for quite some time, right? But again, when it comes to the fundamentals, we're not actually overly concerned in terms of, credit cracking. You've had huge growth in the sector. So you're going to have these pockets that you have, what we call pockets of vulnerability, if you will, but not necessarily an overly correcting market. But sentiment is poor right now. That could last for, quite some time, particularly with the uncertainty regarding the Fed or uncertainty regarding government data and the fact that we're going into the end of the year. But overall, we think, private credit is a great sector in terms of an overall diversified portfolio, and you should have a percentage allocated with that. Now, with that said, you have to be selective, right? You have to be selective with your manager. You have to do your due diligence. But, the negative headlines that we've seen we think are a little bit overblown.
Yeah, right. So you expect, looking into 2026, hopefully that sentiment will shift back to being more positive.
It is, because as you know, we're overweight equity.
Right.
We do think that growth reaccelerates in the second half. We do think that there's tailwinds, whether it's deregulation, some stimulus coming in, and all these types of tailwinds that will help the consumer, help the economy, and we're looking for also an inflation to start coming down as well by the second half of the year. So all this should play well into the private credit market. Not to mention, as we talked about, the market's already pricing in a Fed fund rate at 3% by the end of December 2026. So for a floating rate asset, you're already priced in that lower amount. Our expectation is they might not cut as much as the market is saying. Right. So which is a benefit to private credit.
Excellent. Thank you, Leslie. Last question. You remain with an attractive view on mortgage-backed securities and collateralized MBS. So what's your outlook for MBS looking into 2026?
I think, and listen, this is a long time coming. We've had agency MBS for quite some time. They've lagged investment-grade corporates. We like the securitized market. Agency MBS, as this chart shows, has some of the best returns that we've seen in over a decade, right? So we like the securitized part of the market. We like some of the CMBS, high-grade CMBS. We like agency MBS very much. And for two reasons. One, I mentioned there's corporate supply that's coming into the market that might weaken spreads a little bit in IG. Two, the agency MBS on a yield basis are still over 5%, and then spread basis are still cheap. And also because we believe that similar to 2025, when you had a 10-year yield that was between 4.5%, that range in 2026 will likely dominate. Okay, that doesn't mean you're not going to have pockets where you're below 4 or above 4.5, but the majority of 2026 we think is going to be a range-bound market as well, which is great for a securitized product.
Excellent. Leslie, thank you. As always, I know I'm looking forward to many more conversations with you in 2026 as the markets will continue to evolve. We will, of course, have you here to give us more of your insights. Thanks, Leslie.
Thanks very much.
Of course, anytime. And if you'd like more information from Leslie and the rest of the team, you can visit our website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, you can also check out our channel on Instagram at UBS Trending. Give us a follow there. And as always, if you have any questions about your own portfolio, make sure that you are picking up the phone or emailing or connecting with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. See you soon, everybody.